Unshakeable, Your Financial Freedom Playbook, by Tony Robbins with Peter Malloch. Introduction. Imagine for a moment it's 2008. The world feels like it's coming apart at the seams. The stock market is in a free fall, wiping out fortunes overnight. The giants of Wall Street, the big banks that seemed untouchable, are collapsing like toy soldiers. Millions of hardworking people are losing their jobs, their homes, their life savings. Fear is a virus, and it's spreading like wildfire. Now, picture this: even billionaires, people you'd assume were immune to this kind of panic, are calling one man, their voices trembling. Their cash is frozen, credit has vanished, and for the first time in their lives, they feel the terrifying possibility of losing everything. That man was Tony Robbins. And in that moment of global crisis, watching the suffering and terror all around him, he embarked on a quest. He decided he wouldn't just stand by while regular people were treated as pawns in a game they didn't understand. He set out to find the truth. He used his unique access to sit down with more than 50 of the greatest financial minds on the planet, legends like Warren Buffett, the founder of Vanguard Jack Bogle, and the brilliant hedge fund manager Ray Dalio. These are the masters of the financial universe, the people who don't just survive the storms, but know how to sail through them and come out stronger on the other side. He asked them one simple, powerful question. In a world of volatility, in a world of chaos, what are the rules to win the game of money? How can an ordinary person not just achieve financial security, but true, lasting financial freedom? The answers he found are collected in his one New York Times bestseller, Unshakeable. A book that has sold over 1 million copies and, in a testament to the author's character, has seen every single dollar of its profits donated to feed families in need through his partnership with Feeding America. Today, we're going to distill that wisdom for you. And I'll make you a promise: by the end of our time together, you will understand the simple, timeless principles that the world's wealthiest investors use to create peace of mind in a world of uncertainty. You will learn how to turn fear into an ally, how to spot the hidden traps laid by Wall Street, and most importantly, how to build a financial future that is truly and completely unshakable. Book summary. Let's begin with a simple story. A man is walking down a path at dusk. Suddenly, he freezes. Coiled in the middle of the path is a deadly snake, ready to strike. His heart pounds, adrenaline floods his veins, and he turns and runs for his life. The next morning, in the clear light of day, he cautiously returns to the same spot. He looks down, and his fear melts away. It wasn't a snake at all. It was just a harmless piece of rope. For most of us, the stock market is that snake in the path. We've been conditioned to see it as a dangerous, unpredictable creature that can strike at any moment. The news flashes scary headlines about volatility and turmoil. Pundits with grave voices warn of the next impending crash. And so, paralyzed by fear, most people do one of two things. They either avoid the path altogether, keeping their money in a savings account where it earns next to nothing, or they tiptoe around it, ready to run at the first sign of trouble. But the greatest investors, the money masters Tony Robbins interviewed, they see the rope. They understand a few fundamental truths about the market that transform their fear into power. And the first, most important truth is this: corrections are a normal, routine part of the game. What's a correction? It's just a fancy term for when the market drops by at least 10% from its peak. It sounds scary, doesn't it? But here's a fact that should change your perspective forever. Since the year 1900, the stock market has experienced a correction, on average, about once a year. Think about that. If you live to be 85, you can expect to experience the same number of market corrections as you do birthdays. They are not a freak accident, they are a season. Like winter, they come and they go. And how long do they usually last? The average correction is over in just 54 days. Less than 2 months. It's a storm that passes, often before most people even have time to truly panic. But what about the big one, the dreaded bear market? When things fall by 20% or more, this is the monster that keeps people up at night. Yet, here's another truth. Less than 20% of all corrections turn into a bear market. That means 80% of the time, the scary downturns we worry about are just short-term turbulence. If you panic and sell, you are often jumping out of the plane right before it levels off and starts to climb again. This leads us to the third great truth. Nobody can consistently predict where the market is headed. Not the slick-talking experts on TV, not the Wall Street economists in their pinstripe suits, not the newsletter writers who predict a crash every single year until they finally get one right. As the legendary investor Warren Buffett says, the only value of stock forecasters is to make fortune tellers look good. If the greatest minds in finance admit they can't time the market, what makes us think we can? The answer is, we can't. And trying to jump in and out at the perfect moments is a fool's errand. So, if corrections are normal and nobody can predict them, what's the big picture? The fourth truth is the most powerful of all. Over the long term, the stock market always rises. Think about the last 36 years. During that time, we've had wars, terrorist attacks, political scandals, and the worst financial crisis since the Great Depression. The market experienced an average drop of over 14% within each of those years. Yet, in 27 out of those 36 years, that's 75% of the time, the market ended the year with a positive return. Why? Because the market is a reflection of the economy. And a dynamic economy, driven by innovation, population growth, and human ingenuity, grows over time. When you invest in a broad market index fund, like one that tracks the S&P 500, you are becoming a part owner of the 500 largest companies in America. You are betting on human progress. And as Warren Buffett reminds us, for 240 years, it has been a terrible mistake to bet against America. This brings us to the most crucial lesson about fear. If you try to avoid the downturns, you will almost certainly miss the best days. And missing just a few of the best days can be catastrophic for your wealth. From 1996 to 2015, the S&P 500 returned an average of 8.2% a year. A fantastic return. But if you were out of the market and missed just the top 10 best trading days during that entire 20-year period, your return would have been cut almost in half, to just 4.5%. If you missed the top 20 days, your return would plummet to a paltry 2.1%. And if you missed the top 30 days, your return would be zero. Gone. And here's the kicker. 6 of the 10 best days happened within 2 weeks of the 10 worst days. The moments of maximum fear are almost always followed by moments of maximum opportunity. So, what is the greatest danger in investing? It's not a correction. It's not a bear market. The greatest danger is being out of the market. Courage is rewarded. Fear is not. Once you understand these truths, the snake on the path reveals itself to be a rope. You no longer have to live in fear. But there is another enemy, a much more insidious one, that we must face. It's not the market itself, but the very industry that claims to be helping you navigate it. Jack Bogle, the revered founder of Vanguard, laid it out in the simplest terms. He said, let's assume the stock market gives you a 7% return over 50 years. At that rate, every dollar you invest grows to $30. A beautiful thing. But now, let's say you invest through a typical, actively managed mutual fund. These funds are run by professionals who try to beat the market. For this service, they charge fees. And those fees, when you add up all the hidden costs, the expense ratios, the transaction costs, the cash drag, can easily amount to 2% per year, or even more. So your 7% return is now just 5%. What does that do to your money? Over 50 years, that same dollar doesn't grow to $30. It grows to just 10. Let that sink in. You put up 100% of the capital. You took 100% of the risk. And you got just 33% of the reward. The other 2/3 of your potential nest egg went into the pockets of Wall Street. These are like termites, silently and relentlessly eating away at the foundation of your financial future. To make matters worse, what are you getting for these high fees and/or performance? Study after study has shown the same shocking result. Over any long-term period, 96% of actively managed mutual funds fail to beat the market. You are paying a premium price for a service that, almost all of the time, fails to deliver. It's like paying for a Ferrari and getting a rusty tractor. This is the dirty little secret of the financial industry. So what's the antidote? It's astonishingly simple: low-cost index funds. An index fund doesn't try to be clever. It doesn't try to beat the market. It simply buys and holds all the stocks in a broad market index, aiming to match the market's return at the bare minimum cost. By doing this, you eliminate the high fees and the human error that plague active funds. This isn't just some fringe idea. It is the advice given by the masters themselves: Warren Buffett, Jack Bogle, David Swensen. They all agree that for the average person, indexing is the single smartest path to wealth. But avoiding high fees is only half the battle. You also have to navigate the world of financial advice, and here, the landscape is treacherous. You see, about 90% of so-called financial advisors are actually brokers. They are salespeople. Their job is to sell you financial products, for which they earn commissions. They operate under a weak legal standard called the suitability standard. This means the products they sell you only have to be suitable, not what's actually in your best interest. If there are two funds, and one is a low-cost, high-performing fund that's perfect for you, and the other is a high-cost, mediocre fund that pays the broker a fat commission, which one do you think they are incentivized to sell? Under the suitability standard, they can legally sell you the one that makes them more money, as long as it's suitable. Then there is a much smaller group, about 10% of advisors, who are called fiduciaries. A fiduciary, like a doctor or a lawyer, has a legal and ethical obligation to always act in your best interest. They don't accept commissions. Their advice must be free of conflict. Why would you ever work with someone who doesn't have to put your interests first? You wouldn't. The problem is, most people don't even know this distinction exists. And the industry, with its confusing titles like wealth manager and financial consultant, does its best to keep it that way. Now that we've cleared the path of fear and avoided the traps of the industry, we can finally turn to the playbook of the masters. After interviewing over 50 of the world's greatest investors, Tony Robbins found that while their specific strategies were diverse, they all operated from a shared set of fundamental principles. He calls them the core four. The first principle is, don't lose money. This might sound obvious, but it's the bedrock of all successful investing. Warren Buffett famously said he has two rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Why is this so critical? Because of the simple, brutal math of loss. If you invest $100,000 and lose 50%, you're left with $50,000. How much do you need to make just to get back to even? Not 50%. You need to make a 100% return on your remaining $50,000 just to get back to where you started. The more you lose, the exponentially harder it is to recover. The masters are obsessed not with hitting home runs, but with avoiding strikeouts. The second principle is to seek asymmetric risk/reward. This is a bit more advanced, but the concept is simple. You want to find investments where the potential upside is many times greater than the potential downside. Paul Tudor Jones, one of the greatest traders in history, uses what he calls a 5-to-1 rule. He looks for opportunities where he can risk $1 with a realistic expectation of making 5. With that kind of ratio, he can be wrong 80% of the time and still not lose money. It's about putting the odds so heavily in your favor that you can withstand the inevitable mistakes and still come out ahead. How can a regular person apply this? You do it by buying when there is blood in the streets. During market crashes, when fear is at its peak and everyone is selling, assets go on sale. That is the moment of maximum pessimism, and it's also the moment of maximum opportunity. You can buy world-class businesses at bargain prices, giving you limited downside because they've already fallen so far and enormous upside. The third principle is tax efficiency. It's not about what you earn, it's about what you keep. Taxes are the single largest expense in most of our lives, yet most investors completely ignore their impact. A simple example: if you buy a stock and sell it in less than a year, your profit is taxed as short-term capital gains, at the same high rate as your regular income. But if you hold that same stock for more than a year, it's taxed at the much lower long-term capital gains rate. Actively managed funds, with their constant buying and selling, are a tax nightmare. They generate a constant stream of short-term gains that get passed on to you. Low-cost index funds, on the other hand, with their buy-and-hold strategy, are incredibly tax-efficient. By being mindful of taxes, you can add decades of income to your retirement. The fourth and final principle is diversification. You've heard the old saying, "Don't put all your eggs in one basket." This is the only free lunch in investing. By spreading your investments across different asset classes, stocks, bonds, real estate, across different markets and countries, and across time by investing systematically every month, you dramatically reduce your risk without sacrificing your returns. During the lost decade from 2000 to 2009, the S&P 500 was essentially flat. If you had all your money in large U.S. stocks, you went nowhere. But if you were diversified across international stocks, emerging markets, and real estate, you still made a handsome profit. Diversification ensures that no single event, no single market downturn, can wipe you out. It is the key to a smooth ride and a peaceful night's sleep. So there you have it. The playbook. Know the facts to conquer fear. Avoid high fees and conflicted advice. And live by the core 4. Don't lose, seek asymmetric risk/reward, be tax efficient, and diversify. But there is one final piece to this puzzle. The most important piece of all. Because even with the perfect strategy, even with the best advice, there is one person who can still sabotage your entire financial future. And that person is you. The science of success in any field, Tony has found, is 80% psychology and only 20% mechanics. You can have the best blueprint in the world, but if your mindset is wrong, you will fail. Our brains are 2-million-year-old survival machines. They are not designed to make us happy or to make us rational investors. They are designed to scan for threats and avoid pain. This is why we fall prey to so many psychological biases. There's confirmation bias, where we only seek out information that confirms what we already believe. There's recency bias, where we mistakenly think that whatever has been happening recently will continue to happen forever. There's overconfidence, where we think we're smarter than the market. And there's negativity bias, where a single loss feels far more painful than a gain of the same size feels good. These biases cause us to do the exact wrong thing at the exact wrong time, to buy high when we're greedy and sell low when we're scared. So how do we silence the enemy within? The solution is to have a system. A simple set of written rules that you create when you are calm and rational, and that you commit to following no matter what. Your system is your checklist, your flight plan that keeps you on course even when the storm hits and your emotions are screaming at you to take the controls and dive. And this brings us to the ultimate purpose of this journey. The goal isn't just to accumulate money. Because financial wealth without fulfillment is the ultimate failure. Tony tells the heartbreaking story of the brilliant actor and comedian Robin Williams. Here was a man who had everything our culture tells us to value: fame, fortune, the adoration of millions. Yet, he suffered deeply. In the end, he made everyone in the world happy, except for himself. True wealth, real wealth, is not measured in dollars. It's measured in the quality of our lives. It's living in what Tony calls a beautiful state instead of a suffering state. A beautiful state is one of joy, gratitude, love, and passion. A suffering state is one of anger, fear, frustration, and worry. And here is the most profound decision you can ever make. You can decide, right now, to live in a beautiful state, no matter what. You can decide that you are 100% responsible for your own happiness. Life is too short to suffer. How? One simple tool is gratitude. You cannot be grateful and angry at the same time. You cannot be grateful and fearful at the same time. By consciously focusing on what you appreciate, you change your biochemistry, you change your focus, and you change your life. This leads to the final, beautiful secret. The secret to living is giving. When you shift your focus from your own needs to the needs of others, something magical happens. Scarcity disappears and is replaced by abundance. Find a cause that is bigger than yourself, something you can contribute to, and you will discover a richness that money can never buy. This is what it means to be truly wealthy. This is what it means to be truly unshakable. Commentary. As we reflect on the wisdom in Unshakeable, it's clear that its power doesn't come from some complicated, secret formula for picking stocks. Its true genius lies in its simplicity and its profound understanding of human nature. The book is less a financial manual and more a guide to mastering your own mind. Its central message is that financial freedom is achieved not by outsmarting the market, but by outsmarting yourself. What Tony Robbins does so masterfully is to take a subject that feels intimidating, complex, and exclusive, and make it accessible to everyone. He replaces the jargon of Wall Street with the timeless wisdom of common sense. He shows us that the path to wealth isn't paved with risky bets and hot tips, but with discipline, patience, and an unwavering focus on a few fundamental truths. The most powerful lesson, for me, is the reframing of fear. The idea that market downturns are not catastrophes to be avoided, but opportunities to be embraced, is a complete paradigm shift. He gives us the courage to see a sale where others see a crisis, to be greedy when others are fearful. This single shift in perspective, if truly adopted, can change a person's financial destiny. So, how can you start putting these powerful ideas into practice today? Here are 3 simple actions you can take right now. First, become a detective and investigate your own investments. What are you actually paying in fees? If you have a 401k or any investment account, find that statement and look for the expense ratio. You might be shocked at what you find. Knowledge is the first step to taking back control. Second, automate your financial future. The single most powerful habit you can build is to pay yourself first. Set up an automatic transfer, no matter how small, from your checking account into a low-cost investment account every single month. Let the miracle of compounding do the heavy lifting for you while you sleep. Don't wait until you have enough to invest. Start now. And third, begin practicing the art of real wealth today. You don't need to wait until you're a millionaire to live in a beautiful state. Take 2 minutes right now to practice gratitude. Think of 3 things you are truly grateful for, and allow yourself to feel that appreciation deeply. This small habit, practiced daily, will enrich your life more than any stock market gain ever could. In the end, Unshakeable is a book about freedom. The freedom from fear. The freedom from being a victim of a system designed to profit from your ignorance. and the freedom to live a life of joy, contribution, and true abundance, regardless of the number in your bank account. It teaches us that the ultimate fortress is not built of money, but of peace of mind. That was a summary of Unshakeable by Tony Robbins. We've certainly covered the main ideas today, but a summary is like looking at a photograph of a great feast. You can see what's on the table, but you can't taste the food. The real power of this book is in the stories, the details, and the way the principles build on one another. This summary is your invitation to the feast. If the ideas we discussed today sparked something in you, I encourage you to pick up a copy. Reading it isn't just an act of learning, it's an investment in a future where you are not just financially secure, but truly and completely unshakable. A link to the book is in the description below. Also, if you found this journey valuable, please take a moment to like this video and subscribe to the channel. It's the best way to ensure you don't miss our next exploration into another life-changing book. Let's keep learning and growing together.